Markets, oil giant Shell stunned investors as its latest quarterly earnings came in below expectation, with profit sliding short of forecasts amid softer energy prices. But in a bold move to reassure shareholders, the company kept its $3.5 billion buyback program intact and lifted dividends, signaling confidence despite the earnings missed. And there you have it, cash flow from operations that came in above expectations, $9.4 billion. Adjusted net profit, $3.3 billion. This was a snag right there. The estimate was about $3.5 billion expected, down from Q4 2024, about 28%. But we see dividend that increased about 4%. Share buyback, that's tagged at $3.5 billion. All right, to other earnings now. Japanese tech giant Sony delivered a standout quarterly performance, reporting an 11% jump in net profit as strong demand for gaming and image sensor products fueled growth. Operating income surged even more sharply. Buoyed by that strength, the company raised its full-year outlook, giving investors fresh confidence in its diversified business model. And there you see the sales there up by 1%, 3.71 trillion yen there. Full-year outlook. Operating profits are up 12%. That's the outlook from the company. Operating income that rose 22% year-on-year for the Q3 2025, 515.0 billion. Net income, a big 11% jump there when you compare Q3 2024 and Q3 2025. So it's a good performance there, and they also raised outlook, giving investors more confidence in that company, Sony. All right, turning to the global economy now. Canada's latest services PMI data suggests the downturn in the sector is gathering pace. Heading into this new year, the headline business activity index fell to 45.8 points last month from 46.5 in December. And I'm seeing that trend with most PMIs from different countries right now. Joining me to unpack this, we have Julian Karagesian, is a former special advisor, Ministry of Finance, Canada. Great to have you on the show, sir. Good morning.
Thank you for having me here, Laddie.
So we see Canada's services PMI shows the downturn, accelerating in January. How serious is this slowdown, and what does this signal about overall economic growth in the first quarter?
Well, it's now the third month of contraction for the headline business activity. And what's more concerning is if you look at the gauge for new business, for new service activity, which is in its 14th month of contraction. And you can feel it at an anecdotal level here, and it conflicts a bit with the headline forecast GDP growth of the International Monetary Fund, which is calling for I think a 1.5% expansion of real GDP this year. The services are 70% of the economy. And if they're in their 14th month of contraction and showing no signs of a significant rebound, that definitely conflicts with the latest forecasts that we saw in the fall from the IMF. So it's a tough economy. Unemployment's close to 7%. And of course, we have the major trade policy uncertainty from Washington, as well as the impact of the tariffs themselves.
Yeah, a lot to still think about coming from the U.S. there. But you did mention the services sector makes up, bulk of Canada's economy. Could continued weakness increase, recession risk, or force businesses to maybe cut jobs and spending?
I'm sorry, could you repeat that last part, Lai?
Right, could it, make businesses cut jobs and spending if this, weakness continues?
Absolutely, and unfortunately, in the moment, we're getting like a double hit because the manufacturing sector in Canada is concentrated in the province of Ontario, and the heart of the manufacturing sector is the automotive sector. And that's getting hit by 25% tariffs from the Trump administration. And we've been seeing a lot of plant closures by the big three American companies. So with that kind of situation and dynamic, I do foresee that there could be more labor cutting and less investment. Now, on the positive side, we have these nation-building projects that have been unveiled by the office of the Prime Minister, and now they're in this new office called Major Projects Office, based in Calgary, and there's about a dozen projects, major infrastructure projects and energy, that have been identified and that are going to be eligible for government investment and open to foreign private sector participation. So I do see on the other side the wave of infrastructure spending coming will be a plus for employment, for wage growth, and for GDP, but it's going to take time.
And mostly this has implications for currency. How's the Canadian dollar reacting to this softer data? Is the currency markets now pricing a possible, rate cut from the Bank of Canada?
Yeah, it's interesting because you have two major forces that are opposing. As we saw earlier in the weekend, energy prices, oil prices were going up, and that pushed our dollar up because we're a major exporter of oil. 5.5 million barrels a day is produced in Canada, and a lot of that is exported. So an increasing price of oil earlier this week led to a bump up in the Canadian dollar versus the US dollar. But now we're seeing continued service sector softness, and that's starting to hit our dollar. So we have these two forces that are probably going to keep battling for the rest of this year.
Right, and all eyes still on the oil markets. At this point, we did see a pullback earlier today. We'll see if we'll get a rebound at this point. Thank you so much for joining us today. It's great having you as usual. Thank you so much.
Thank you for having me, Laddie. Take care.